Morning traders, could I get a audio and screen check please in YouTube and Discord? Thank you. Morning everyone, welcome to the Traders Lab. I'm your host Tom B. Thanks for visiting today. Free FOMC. Appreciate you stopping by. As always, every day in the market is unique and also interesting, and today is no different than any other. I am using so you guys know, and I need to remind you, if there is an issue with audio or the stream, I need to know right away. And if for some reason someone posts either in YouTube or the Discord chat, Trader Lab, that there is an audio issue, if you are not having an audio issue, please post immediately that you are having, that things are okay for you. This way I know it's not global, it is, specific to an individual having their own hardware issue. So that would be most appreciated. I am trying to troubleshoot some things here. Go grab a pen and a piece of paper. I'll give you some statistics and notes, and then we will get into the live market. But first, we'll take care of business. General disclosure, all Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Grab the pen and paper and let's go forward. Okay, first of all, write this down. And one of the things I do, I am attempting to share my experience and market understanding. And this stream is about integrating Bookmap order flow tools using a tool called the volume profile, which is based on price and volume. The stream is about market mechanics. How does the market work? And many of us basically think the market is really, we can define that by our indicators. And and by the way, at times you can, and other times, of course, you can't. Everything is random in the market, but most retail traders are using indicator processes and time frame processes to attempt to kind of fit the market into some order and then operate in that's call that structure. The thing about that is that most retail traders never really get a market understanding. They're looking for the indicator to define the market, when in reality, it's really the other way around. The market is defining these indicators, but the indicators are lagging and they're not sensitive to the condition of the market. And that's, I think, where the kind of the conflict lies, and why most retail traders don't succeed in this business is because they're trying to create a generic process and kind of put the market into a box where the market doesn't operate that way. And that's why the stream focuses on mechanics, understanding how the market works, because the market goes into different conditions intraday. And we're going to see that because that's exactly what's going on today. Also, we had a big sell-off yesterday, right? And if you're in the Trader Lab, you remember we gave you a downside target. And the outside target, and this was at the end of the stream, I said 50 was our outside. I think the low of the day was 47 or something. Yeah, 47. So there's no precision in trading, but there's a reason that we might at times uh, get an indication of the possibilities. So, and yesterday was just short, 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 and why is today maybe long? If you can't answer the question, then you really don't have a grip yet on market mechanics, and that's the purpose of the stream. And in addition, the other part of this is to share with you structured trades that you can reverse engineer and apply to the market condition if you can isolate it and identify it. And then the idea is to have different plans for different conditions. It's not a one size fits all. And the best example of something like this is buying or selling the mid. There are times when the market is just crisscrossing over the mid. That's one type of market condition. You would not be getting involved at the mid. Instead, you'd be buying outside edges of this rotation because it's a rotational market. The other times the market is in a directional move and then the mid might be appropriate. You need to know the difference. And if you can't tell the difference, what's going to happen is you're just going to be trading mechanically with a one size fits all. And as the term goes, get chopped up. Now we all get chopped up. But the point is that if you can differentiate the condition of the market, it may improve your metrics if you can make an adjustment to it. It's almost like if you're driving a car on a flat, if you're out in the desert where you can look over the horizon and it's a straight run on a highway, it's kind of, or, pedal to the metal and off you go. If now you're in the mountains and it's a narrow, winding road, you're not going to drive the same way, are you? Well, it's no different than the market. Sometimes it's a winding road or a rotational road, and other times it's a trending or directional configuration, pedal to the metal. It's a poor analogy, but I hope you understand that you don't just learn to drive and drive one way. You adjust to conditions. And that's part of what we do here in the Trader Lab, is to help traders identify, define, and create process to identify conditions. So it's a conditional process, and then it's having structured, vetted trades that give you a statistical edge to operate in these defined conditions. And there aren't that many of them. So it's that part, but it's identifying it that is challenging. And traders don't understand. And for myself, the most difficult thing, besides the emotional management and all the other psychological aspects of this, was differentiating the condition of the market, because I didn't understand that. And there was no one around to tell me about it. I just didn't understand. And that's part of life in the fast lane. So grab your pen and paper. Here's a couple statistics. Remember, if you have questions, write them down. I'll do my best. I'm going to ask in the Trader Lab that you keep your posts, to questions. And in YouTube, there's probably a 15-second or so delay. So please be patient if you post a question. And I assume my audio is okay. Is that correct in YouTube, since someone posted low audio? Is that right? So here's the statistics. In the meantime, I'll wait for YouTube here. Um, Hold on. Got a little problem here. Hold on, guys. Okay, I'm not hearing anything from YouTube. Is YouTube working? Okay, thanks. Thank you, Shop. Appreciate it. Okay. Thanks, guys. All right. Here's the current condition of the market. Write down a couple statistics. So what did we do? Let's go back to the open. We opened just above yesterday's low and above the overnight low. Okay. And so that's the first thing. I'm going to give you some stats and then we'll just run from there. Okay. So there's a 93% probability we'll take out either the overnight high or overnight low in this configuration. There's approximately a 98% probability we'll take out either the first hour high or low. That's called the IB. By the way, here's the IB, first hour, which we don't know at the time. This is current. This is the highest volume area. I'm sorry. Whoop. Wrong, wrong screen. I've got multiple book maps running and whoops. Come on, get back here. Here, overnight high, first hour high, which has already been put in. This is yesterday's highest retail price. It's called the naked volume point of control. There is a 70% probability we'll get there. There is a 69% probability we'll take this out. And the overnight high, we have, where is it? About a 50% probability. But, and here's the thing about it. If the first hour high has a 69% probability, I don't think it's a big reach to get here, do you? And this was retail. So the thing is, if this is the fair price, and fair price in the volume world is defined as highest volume, in other words, retail. Uh, one of the things about auction market theory is that, when you hear the word theory, you want to go and get a PhD. Quite frankly, if you've ever gone to the store and shop, you're an expert in auction market theory, because there's a retail price and high volume takes place at retail. And then when it goes on sale and price rotates under what you as a shopper perceive as a fair price, and it's a sale, but you think this is fair, retail, you'll buy it because it's on sale. And then the sellers will raise the price up back to retail. Isn't that how it works on a sale? Well, what happens if those sellers raise the price? And you figure, hey, this thing's worth $1, but these guys want $1.10. Well, all right, I'm in the store, I'll buy it. $1.25, $1.35. I'm not paying that. Now, if the sellers want to sell the product, they're going to lower the price back down to retail. This is what creates our rotations, okay, or consolidations. Now, here's the other piece. Suppose we do this activity, and then the participants who are interested in buying the product at retail or on sale or even a little bit higher, but the sellers say, you know what? I think we can get more. Let's just raise the price, raise the price. And the participants can't go back here and buy it here. It's no longer available at this price. Now there's a new price, and we start rotating in here. And the participants, the sellers, will sell it to you up here, but you, because you desire the product, will pay up here. This now becomes a new retail price. This is how pricing works. Well, that means a new consolidation, and that means this is too low. And this process goes up and down a price ladder. That's kind of the mechanics of the market, okay? So let's go back to a couple other things here. So 44.65. And let me give you some other statistics. The overnight volume point of control, write these down. The overnight volume point of control is the highest volume in the ETH. Same process as what I'm showing you here, except here in the ETH was retail. So retail, retail, retail yesterday, retail ETH. Let's just write these stats down. ETH, or overnight volume point of control, 83% probability will take that, and the overnight mid, 83% probability will take that one. So you're starting out down here, and of course, what do the average mortal retail trader think? Oh, let's get short. We're going to go, and this of course has a potential statistic, and these are downside targets, so you know. 38, make a note of these because they're still going to be relevant. Maybe not today, or maybe after FOMC, or maybe never, right? Trading. And this is our outside target, 44.20. So this is intermediate time frame, high volume. This is the same as that level above and the same as this. This was retail, right? This is retail below us, below yesterday's low. This is an intermediate time frame. So this is kind of the area that we're going to operate in. Now write this down. The market goes up to go down, and the market goes down to go up. Market goes up to go down and goes down to go up. So what have we done? We went down. What did we do before we went down? We went up. Why does it do this? Write this down. This is such a basic concept, but we get myopic. We quote expect certain things. Well, I'm a little different. I anticipate. There's a difference from expecting and anticipating. When you expect something, your mind filters out what might happen so you can respond to it. You're only looking for the thing that supports what you believe to be true. In trading, you really, in my opinion, you can't afford to think like that. You need to think in what might happen and you anticipate it. And part of a trade plan is what's the condition of the market? Market's short. What are the possibilities? Everybody thinks the market's going south of the border, and they might be right. But how might it get there? Does the market just go straight down? And of course it can. Or, or if the market is short, what's in the market? Buy stops. If the market runs out of sellers, what happens to those sellers? They cover. That becomes buying. What is stacked above the market? In yesterday's range, buy stops. Is this logical? It's so important you think this way. Are you guys tracking? This is like a basic tenet of trading. Before you even open the door and sit down, you need to know the probabilities and the possibilities. So let's go take a look, okay? Now, I'm going to go into the open and I'm going to show you structured trades that are available to everyone in the Bookmap Discord Trader Lab chat. Here we go. So this is the open. It's right under here. We open right by the low of the day. Let me, right here. Okay. And there's two possibilities. Of course, we can take out the low, come under here, and of course, this would be the target. Or open, jiggle, and if we can't get under the low, or even if we came under it and came back inside and we don't hit this statistic, then the possibility is to squeeze. Here's the other piece. This was retail in the ETH. So it's almost like if this, and we don't know, if this is the fair price and this is perceived by the participants as too low, we can come back here, right? That's why you have over an 80% probability for these two locations and then, north. So let's watch. Okay. Is everybody tracking? Let's watch. These are now I'm going to share with you structured trades. Now there's other trades in here if you have a plan, but in the Trader Lab, the goal is to help you put a plan together. This is not making sense to me. I don't know why it's doing this. Always like when this thing is. Okay. So this is called the developing volume point of control. And what this is retail. So this is showing you high volume. Remember, too high, too low, retail. Now this is microstructure. So what I'm going to be looking for here is I want to see the behavior coming out of the open. Now initially I'm thinking, now don't forget, market goes up to go down and goes down to go up. So I'm going, well, we have this and we have this. This is possible. That's one piece. And the other piece is, do we just get short covering and then a responsive buying and then continuation down? Now I don't know. So I'm going to tell you, I wish I know. I don't know. This is the joy, right? The joy of not knowing. So this is yesterday's close, but this is the retail price in the last auction. That's that yellow line, and that's showing us the highest volume with the statistics. So I'm looking at this and I'm going, okay. Now, if you get short in something like this, you are very aggressive. So what I suggest is, and again, it's subject to a vetted plan, that you just wait because we might get the following: responsive buying, and then the sellers come back in because they go, oh, it's an opportunity. We're above yesterday's low and we have this statistic. So I'm just saying it could go either way. This is trading. Nobody knows. Wish I did. So too low, This is called VPOC migration. Volume is moving higher. This now is the new retail price, saying potentially too low. Volume moves higher, saying potentially too low. Now volume starts moving down, saying potentially too high. Watch, just watch. Potentially too high. Now this is all microstructure. These are not trade recommendations. There's a couple pieces to this. First of all, the condition of the market or context. Market short, we know that. Market looks like it fell out of bed yesterday, of course, and it looks like it's going south of the border. We're looking for the Acapulco cliff dive. Anybody who didn't get short yesterday is feeling FOMO. Why? If they didn't get involved yesterday on the short side, think about how you feel emotionally. Now remember, talking emotions and retail trader behavior. Think like a retail trader, don't act like one. What would a retail trader do today? They'd be selling this thing, right? And what about the shorts that are still in there? Well, they would be covering if they're on the hook. So you have potentially new sellers coming in, maybe, and you'll have the current shorts, if they don't get any love, they're going to be out of here. So right here, it's too high, right there. Watch it. So here's what you have. This is the rotations. And down here, this little high volume was that retail price that was too low. You see? There it is. So this says potential counter rotation. Now, who knows, right? So let's look at it. This was too low. We're going to label it, right? It's called the variable high volume node. And all it is, it's very simple. It's where the volume took place. I'm wondering why I'm having a with this aggregation thing. It's one of those things that you go, well, why? So this, if you want to think about how this works, this right here is too low. That's where the first volume came in and the first buyer showed up. This is VPOC migration. And you can see this high volume sitting right here. So think of this. Remember at the top of the stream, I said retail. If the price is too low, the shoppers can come back and check the price. If it's still too low, you can't buy it there. And then they're going to have to come back to the store. And if they come back here and we get above this opening swing high, which by the way is a double top week high, and if you're a retail trader, I know when I first was learning trading in 1980, double top was, oh, you'd sell that. No, 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 no. It's weak. It's not rejected. It's exhausted. It's a different kind of high. So if we look at this as the opening swing, remember, up, this is the high. Where's the opening swing low? It's right here. And it's not unreasonable for this thing to pick and then come back. But I know this is a location. Now, remember, there's no precision in trading. It's horseshoes and hand grenades. So it could come to a level, it could come through it, it could, or keep going, right? Don't we know that? It's random. So let's watch. Right here is too low. Now, at this point, let me show you a trigger. And I'm only going to show you, I'm showing you potential trades. I'm not saying these should be your trades. They're not even necessarily my trades. But if you're in the trader lab, you would understand what this is. Now I'm going to take you into microstructure for the trigger. Now, it takes guts, You're right above yesterday's low. What's the worst that can happen to you, by the way? Take a stop, right? So right here, we already have a location that was too low. We have a weak high. This is how you kind of go, if this, then that. If not, then what? This is how you narrate. If this, then that. If this is a weak high and I rotate down and I check this level where the buyers come in, you see how you put the pieces together? And I can't, or I just, bump this and come in above here, then it's a long. So we're looking for a long. Where? Let's look. Now, I don't know. I'm as clueless as everybody. Here's a triggering structure. Let's look at it. Okay. Here's how this works. And again, it's all random. So there's nothing mechanical. It is all these pieces I put together, which give me the idea of either an aggressive short, which is, which might work, or a long. And it could be either one. If you took the short, this is a structured trade in the Trader Lab. This could be a short. But if you're thinking who's on the hook, and this is what the context is about, the market is short, there's buy stops. You have to look at it from two sides. Here's the buy trigger. I'm down on the stops, micro high volume. This is high volume. Think of it like this: too high, too high, too high. I'm showing you the short side so you can get a sense of it. Right here, high volume, too high, microstructure, volume, too high, break low, too high, break low, pull back, too high. It's checking the volume. Oh, I'm not selling it to you there. Come down, too high, going lower, right? Here, what happens? This is the Bookmap Stop an Iceberg detector. It reads what's called MBO data from the CME, which means all orders are tagged, right? They got to know if it's a stop, a limit, market order, iceberg, whatever it is, right? So they're tagged. MBO data lets Bookmap read what is here. Well, indicator world, we know about divergence, right? Well, if we're coming down, and I'm looking at this, and I see the sellers, the sellers, the sellers, the sellers, and I see only one stop go off. And I'm still looking for, because I don't know. Right here in the microstructure, here, so too high, exhaustion, break high, pause, potential long here, or, let me give you the or, break high, pull back here. Now this is too low because we rejected the volume. So right here where that's labeled is too low. Now, this is not easy. I'm not saying it is, because you're going to be conflicted. But what I think about is before I start, I think, and I don't know what the market's going to do. So nobody's got that. Well, it's about knowing what it might do. That's what you need to do in a trade plan. Say, I don't know what it's going to do, but it might do this and it might do that. And it's an if this, then that process or conditional process. What's the condition? Well, the condition of the market. Then what's the conditional process? I get selling, and if it doesn't, go, and I see my buyer, see the bubbles? That's delta. So exhaustion, buyer. Let's look. I want to show you this. There's your seller. There's your test. There's your seller. Here's your buyers. Look at the range of this rotation versus this. This was your support level, you see? So we come out, exhaust, long. Now what? Uh-oh, what's up? Is this too high or is this too low? Let's see. So too low. Now, watch. See? So your long is either in here or on this pullback. This is your support and the north. First target, next target overnight mid. Now it gets real interesting here. I'm going to show you this. Let me just make sure I've got the right locations here. Now there's no way to know what it's going to do, so don't even think about it. Now in the ETH, this is called a low volume node, and I'm not going to get into too much detail about it. But in the ETH, this was an outside edge. Think about too high, too low, and retail in the ETH was here. See? So this was an outside edge here. in the ETH. In other words, this was too high, and then the market was rotating down towards that overnight low and around. And this was retail. Well, now we're coming back outside. This is retail in the last auction, which is ETH. This was too high. I have liquidity in the book up here. This is important because right here, if I can't get through this, I'm going to rotate back down again. So I don't know. Let's see what it does. So you'd be long. Now, next target. Let me show you. Here. This is the next target. This was yesterday's high volume location or retail. So in the ETH retail, that's why it's a target. You get above it, what's the next target? Here. And then we have this and this for targeting on the long side. Now I'm going to show you a couple other structured trades. Now, some of what I'm going to show you is counter trend. So I'm not suggesting this to anybody. I'm just going to show them to you. And then you guys can sort it out as far as how you build out your trade plan, you know? So let's look. This is the, remember how the market works. What's too high? What's too low? What's fair? The market is an auction. Its job is to check what's too high, what's too low, what's fair, and the rotations in all fractals and time frames are a function, like here. Here, let me show this one. I'm just going to show you, I'm pulling this out of left field because I want you to see microstructure. Here's the market, here's volume, buyer. It's saying you can't buy this here. And you can see the little nodes sticking out there. I'm in this fractals now. I'm in very short time frame, and it's only a way to try to let me turn this off here. So like here, chop chop is an auction. Volume is here. You could see it over there. We break away from it. That's saying, no, you can't buy it here at the moment. Now we pause here. We have a little chop going on. Consolidation. That's what these are. And that's like they pause and they go too high, too low, retail, high volume, break away from it. There's the buyer. Too low. See the similarity? Too low, too low. Now here, chop chop, break away from it. Too low. Test it. Too low. See? Up here. Now we're balancing here. Break high. Too low. Test it. Too low. Break high. Volume. Pull back. Test it. Break high. You see what I'm kind of what I'm doing here? This is how you might try to stay in alignment with the thing. And you have to decide or vet how you might use a trade management process. And that's becomes, and the solution to all of this is statistical. It's not how you feel about it. It's not, gee, if I do this, I missed a 40-point rotation. It's all the trades, guys. It's all of them. It's not one trade. And most of us, when we start out as retail traders, we build our life around the big trade, you know. Oh, what indicator would have caught that? And, you know, all this, right? We've all done that. So yeah, we're, we're all the same. Here's the volume. Here's the buyer, right? Too low. Look where we come. Too low. Now, I can't tell you where you trail your stop. It's really a statistical answer. Right here, this price is too high, and there's your counter rotation. As soon as you see the seller, you just might want to be out. I don't know. It's up to you. What time frame do you trade? So let's look. So too low. Now remember, this is our next target. Why? Because it was our retail price from yesterday. Next target. Is everybody tracking? This is the long, this is the target. Now we have the bonus round. This has over a 98% probability, first hour high or low will get taken out, and the overnight stat, this one. So in theory, you could be done here, or you're holding a runner for this, and I'm not sure what's above us. this area up here. And we'd have to take out yesterday's high, you know. Good luck with that. But it's possible, you know. So these are targets up above, not trade recommendations. Notice 80 has liquidity in the book, but these are the primary intraday targets based on the auction. Now I'm going to show you a short that I took. Not, and I'm not saying anybody should do this because this is definitely counter trend, but you'll understand why if you understand the auction. So these are all longs, you know, up to here. And then I'm going to show you the change in the context and how this changes. Now we're through this low volume area from the ETH, so that can go. We can jettison that. And there's one other piece I have to add back in here for you. Remember, now this out here, when you see this kind of move, this explosive move, we are basically leaving this consolidation. In other words, this whole area over here, we're leaving it behind and we're running. This is too low. So where's the outside edge? This is always the thing we don't know in trading. Well, there's one here at 53. I'm going to put it in here and you'll see why it might matter. And I say might because who knows? So it's called a low volume node. Let's put it in there. Takes time, but I got to do this. By the way, if I don't label things, I forget all about them because I'm myopic. My brain, you know, I'm kind of like right here. You know, that's kind of where I am because I'm managing and I'm actually interacting with the market here. But so I don't want to forget these locations. Here's another outside edge here around 55, 56 out in here. Low volume area. I'm going to label this one and you'll see why it matters. And this is based on the auction. Remember how the auction might work? And I say might because everything's random. Is if the where's the price too low? And how does the market tend to operate? It tends to seek out what's too low. And if the buyers perceive it's on sale relative to what they perceive to be a fair price, they buy it. And then the market might return back to a fair price. And then if it gets too high, the market might come back to the fair price. So I'm not paying that. Oh, but it's on sale. Yeah, but this is retail. So that's what creates the rotation. All right. So let's now take a look. So we're coming up. This is the target. All right. And there's more, but the fact is this is the key price. So targeting, and then that was it for me at the moment for the longs. And then I'm thinking the following. If this is yesterday's highest volume or retail price, is it too high? If it is too high, we can come back down. And let's look at this microstructure. And this is not something I recommend anybody do because you have to already have your game on if you're going to be a counter trend trader. Okay. If you, in other words, your job, at least the way I see it, and I'm not saying your job, I'm saying if you're building out a business of trading and a trade plan, you want to go, you want to take, you want to go with the strong hands. Who's the weak hands? Well, the shorts, but are they done? Is this price too high? That's the question. It was retail yesterday, and what does the market tend to do? It tends to come back and check prices. Remember the shoppers. This happens in all fractals and time frames. So I know that the market, if this is too high, that this could be it. And I don't know. So let's watch. Let's look. So right here, you see liquidity in the book. You see buy stops coming out. You see the location. Let's look at the structure. This now becomes our high volume, and it's created by this right here. I see the seller. I have the liquidity. I have the target and the location. So let's look. I'm looking for a short. So the short would be here or here. And I don't know. Watch. Let me pull this down. I took this short. And like everything, I took it and I said, you know, this. But it's the reason is in the auction, the market tends to come back and check. Now, what it'll do? I'm as clueless as everybody else. Here it is again. So we have this structure. I see a seller. And here's the key thing, location. Here, again, the volume. I see the seller. I see the seller. I see the test. I see the seller. I take a short. VWAP. So I took the short, scaled, VWAP, and then I'm looking for it to come out. Watch. Now we have another setup in the Trader Lab called the VWAP to the VPOC. Now I'm thinking the trend is up, but I know this might be too high. That no clue, right? So I have the IB stat. So I'm looking for longs, except I took a short. Why? Return to the mean. So this is the mean from yesterday, and the mean means where the high volume was. In the developing time frame, this is the same thing, except it's developing. So if I get short against this, then the target is back here to the mean. And then if I come outside, it's if where's too low, and then I can return to the mean. This is called mean reversion. Mean in a higher time frame, back to the mean. So I'm mean reverting. That's why the long. I get back to the mean in this time frame, too high, and again I don't know. And then I come back to the mean in this time frame. Then I come outside, structured trade, VWAP to VPOC, back to the mean in this time frame, looking for this. Is everybody with me so far? Is it logical? It's full. The FVP column is the full volume profile. So what that is showing me is all the volume starting from 5 p.m. Central Time yesterday. So it's the ETH. So when RTH opens, there's no volume here because this is only measuring RTH. The one on the left, FVP, would show me everything in the ETH. Then as the RTH fills in, it just adds on to the FVP. I hope that answers that for you. So the short to here, to here for the long, or here, looking for this, okay? Because I have an IB stat and an overnight stat. So this is outside in, mean reversion. I took this, I scaled, and then that, that's life, out. Now I'm looking again. Where's my outside edge? Here and here. So I'm looking now, remember the concept. If this is the mean from yesterday, then, and this is the mean today, which is why I took this outside in mean reversion, I'm still thinking long from somewhere. What else do I know? If we don't come back to here or here, which is the low volume outside edge at the moment, then the possibility is to take the stops. Same reason we went up was to take the buy stops. Now we have longs in the market. Where's the stops? Well, this was a good long because it's structured. Once we come under here, then you got the mid and you got whatever's below us, and who knows. So now let's come back. Let's go. Okay, we're coming outside. Do we think the trend is up at the moment? Well, I did. So I'm trading from the long side until it breaks. What I don't know, which is the magic of trading, is from where. Now, this is at the time, this is the mid, but I'm not thinking about the mid. I'm thinking about where the fuel is, retail trader behavior. They keep their stops at the mid, and they also activate at the VWAP in the mid. So this to me was valid. Once this happens, then I'm looking for the stops to come out. And then it's either a long back here or not. And I can't tell you what it is because I don't know. But I know I have to get back above here. That's why this is labeled. And I don't. Instead, it breaks, pulls back, can't get above the mid, and then I'm going, what's going on? This is my next outside level. So let's look. There's my volume, and this becomes mean reversion. So, it's sorry about that. So basically, now this is a potential triggering structure. If it's not your trade, it doesn't matter. Let's just watch the behavior. I got on this one, and I will tell you, I can't get on it over here because I can't figure out what's going on. I wish I could, but I know this was too high. Let's go back to this. Too high, too high, too high. So I'm narrating, I'm going, yeah, it's going down. I'm looking for, remember, if this, then that. If not, then what? Looking for this, I get this. Change in behavior, too low. You see? And there's the micro high volume. Now, for me, no clue. Could just keep going. I have no idea. Break high, there's my buyer. This was resistance. And what's the saying? Resistance becomes support, support becomes resistance. This is along here. And now I'm going back for mean reversion, which is rotational trading. So it's outside in trading. Outside is here. You see? Does that make sense, guys? Right here. Can you see it? Does this make sense? How are we doing in YouTube? Now, I know this is slow and meticulous. I get it. And I also understand what's happening right now. Uh, it's not a trade calling room. If you can't do it, it's a waste of your time because this is for you to do it. There's not a right way to trade. There really isn't. It's all metrics driven. You may find this nauseating to activate in this back to here. You may go, that's scalping. I've had conversations with guys that think an 8-point swing is a scalp. And to me, I only do use the structures because I can read them. I know what they mean because this is a language. And if I get long here, my stop can go here because I know what made it. And I know what this was and why this happened. I don't know it's going to turn here. See, that part I don't know. But I can look out here and look at levels and go, well, this is this outside edge here. And if it's too low, we're going to come back to retail. If I fall through here, which it can, then where's it going to go? I don't know. I see this and I know there's all stops and everything under the mid, right? But then we exhaust. You see, that's what I know. I don't know this is a reversal point until I see the buyer. That's what I know. So, and it's just one way to slice and dice it. You could do it any way you want. There's not a right way to do this. But here's the other thing I know. Right here, let's go back into the microstructure. Right here, you let me just show you this because this is like Russian dolls. It's all the same. Right here, we have this rotation, right? And it was created by the excess here, this volume, you see? So there's the volume in this structure. Let me show it to you. I just want you to see how you might narrate this here, remember? Which is where the short was up against there. This is the logic of the auction. Here's the volume here, and there's the high volume node. That's too high. So, and we reject it. I'm not paying that. Narrate. Well, if we reject it, so here was an outside edge. We went higher. Here's the volume. Here's the break. Here's the test of the volume. And there's the seller. So we know that's rejected in alignment with that. Right there is the high volume. And when we fell out, you could see this is a distribution. It's representing the volume in this consolidation. So this is an auction, too low, too high, and then in the fractal, too low, too high, volume, volume, fractals, out of here, too high. So now I know this is too high and this is potentially too high. Don't know. And if I come back from the outside, I anticipate if we can't get over this at the moment, we're not going anywhere. We might only come outside and then come back. And this becomes a context called mean reversion. It's rotational trading. It's a different context. So I got outside, right? I got up here. I got short. Just coming back here. Don't know. Here to here. Now watch. So all this goes on and down we go. Then what is the context? Outside in mean reversion. There's the mean. So that's why it's a long. Then what's too high? This. If I come back to the mean, what's the possibility? Outside edge. This is where it was too high, so it can come out here. Also, you have something called the developing value area high, which is where most of the volume for the day is at the moment. So that's another level to observe. So this is the outside edge. So long to here. And remember, what's here? Buy stops. Shorts come in at the mid. Oh, it's going down. It's all over. Maybe. See, you never know. Take their stops. Take their stops. Back to the mean. Now, right here, it could just bounce off and continue, or this leg with buy stops above this, which is a weak structure. You see these tops? This is just like your double top. It's a weak structure. These are exhaustive structures. What's above here? Stops. Outside edge. Watch. Outside edge. Now for me, now there's a couple possibilities. I'm going to give you the possibilities. Now I'm still looking for the stats, so I'm looking long. So I'm holding longs. Now I also know that if I can't get through this volume, that it's not so good, you know. But I'm thinking I have over 90% probability of, these, so I, want to get there. Where do I go? Here. What's that? Isn't that what we checked before? Wasn't it too high? No, I don't know. Yeah, I wish I did. And look what happens. Watch the behavior. So now this is retail. This is our outside edge. This thing is no good anymore because we took it out. We're going to take it out of here. This is what's called rotational trading. This is mean reversion. So it's outside in. Now at this point, there's no way to know. I mean, we're waiting on stats, right? So there's no way to know what's going to happen. This was too low. This was too low. What do? This is too high. This is rotational trading. It's called mean reversion. Now I'm thinking long. So for me, it's scaling, targets, hold. Yes. Trade management. You get taken out. Where's my last place? It was too low. Here, out here. It comes out and it holds my level there. I'm out. Watch. Outside edge is here, 53. So watch. Too high, seller. Too high, seller. Here's the volume. Seller, volume, seller, volume, buyer. Pull back to the volume. 53 is my area, and there's no precision. Buyer, mean reversion. Watch. This is your level, remember? This is a specific context. It's called mean reversion. And where do we go? Here. Is everybody tracking? I can move on from here, but I want to show you how it changes. Now, nobody knows. Right here, remember, this is our target, primary target, and we're looking for this to get taken out, and we're looking for this thing, you know. And, you know how that works, right? Now, change in behavior here. We break out of this consolidation. This was the outside edge. If we fall out, that suggests what we'd suspected, too high, but you don't know. Now this is maybe too high. Let's watch it. Watch. We fall out. Warning, Will Robinson moment. Where do we pull back? Here. What's that? This. What's that? The outside edge that we fell out of. Support becomes resistance. Short. And you might, here's the thing about it. When we fall out and we come back, you don't know. I wish I did. But here's what I see. Microstructure. Seller. Oh, it left without me. What does it do? Comes back and checks. Microstructure, retracement, location, short, helmet. IB stat, overnight low, next target. And we get rolling. So this is the next target, not a recommendation. And this. And this is what I gave you at the top of the stream. And of course, none of this happened. You know, it's happening. I didn't even know that we sold off. But the fact is, this is trading the auction. It's a way to slice and dice the market. I'm not saying it's better than anything else, or I have no opinion except what works for me. And the reason I can do this is I'm not using any indicators. And I also accept I don't know what's going to happen. So I'm off the hook on knowing what's going to happen. My job is to try to stay in alignment with the market. And when it changes its condition, I try to stay in alignment. So you'll notice what we had, longs to here, looking for statistics. And you do notice that the statistics favored the downside versus the upside. But the statistics are only one piece of this. The short squeeze, remember the market goes up to go down and goes down to go up. We went down, so now we went up. And now we went up, since the market goes up to go down, we got the shorts out, the weak ones, and now what do we get? The sellers are picking up the inflated prices for the trend to continue down. That's the logic. And that's why I go over these ideas at the top of the stream. It's conceptual because we're in a random environment. So this was the last short, subject to, again, your trade plan. Now, depending on how you do your thing, you could be rocking and rolling in this if it's vetted. You could be trading rotations. You could be managing your trade with this. See the selling? Here's the high volume. There's the seller. We stay below here. This is resistance. Notice the test. Now, you know, this is the target. No, not a recommendation. So you can kind of see what happened here. We had the IB stat. Remember, we either take out the first hour high or low, almost a 98% probability. We take out either the overnight high or overnight low, 93% probability. Taking out the previous high or low, 85% probability. Let me take it a little further. The previous point of control, 70% probability. You see? The overnight low, 66% probability. Yesterday's low, you find it, 53%. It's more, you see. Oh, this is left over from the last time we traded down here. We haven't been here in a while. And this is down below here is a key target eventually, and it's not a recommendation. So this is on the hip parade. And again, there's no way to know how the participants will price. So this might be it, or this or wherever. Is everybody with me? We're now current, and remember what the purpose of the stream is: to help you understand market mechanics. That's primary. Market mechanics means understand the condition of the market. You notice that we went from long to rotational, long to two-sided up against here. That was a short, staying long for mean reversion back in to hit this statistic and maybe go higher. Failure, and it was outside in trading, which is called mean reversion, leaning long. The short was strictly to wipe the stops out and come outside to come back in. You see, so you could be counter trend if you're, let's just say, have a statistical edge and maybe more experienced and skilled, and or you just use this for targeting for exits, and then you're going to stay with the perceived trend, because when you recognize two-sided trade, so it's only longs. When you come out to the low volume area, it was only longs. You see, when you break below here, you turn the barge around and now it's only shorts. Does that make sense? Are you guys with me? How we doing in YouTube? Yeah, N7, thanks for visiting. Well, I'm doing something that I can't have an opinion on it. This is raw market mechanics without indicators, and it's really what indicators are built on. Indicators are built on price, and they're backwards looking. They measure price or some other elements, but they're all pretty much derivative of the same thing. And it doesn't matter how you slice and dice it. And like everything, it's random. So indicators work really good at times. When we slap them over a big rotation, we think now we're going to do, it's all going to work out. And it kind of works that way if you think about how gamblers operate. Sometimes, they bet and they get a big win. But over time, the casinos extract the dollars from the gamblers, and we're in the same business. We are the casino, hopefully, and not the gambler. Most retail traders are just gamblers, and that's why they don't have longevity. So what I attempt to do in the Trader Lab is just share my experience. And it doesn't mean that I have great experience or anything. It's just a lot of time and a lot of mistakes and a lot of dead ends. I call it Trader Groundhog Day, doing derivatives of defective processes that are random and conflicted. Uh, I had to go in the other direction. And it was because I couldn't measure things, because if it's a little of this and a little of that and you're making a stew, that's not how the casinos operate. Casinos operate strictly in a disciplined fashion, only playing games, if you will, with a vetted statistical edge. They don't change the game. They don't change it a little bit. They don't mix it up. They just do the same thing. Well, that's our business. And for the casinos, the losses are costs of production and overhead because they have the edge. They're not concerned as long as they don't change the game. They don't get emotional. If somebody walks out with a suitcase with 100,000 in cash, that's cost of production and overhead. That's the way it works. Anyway, let's go back to real time. So I'm saying is this is a process, and all it is, it's simple. You see, I know myself when I started trading, I thought it was really complicated, and I guess it is. If you don't understand it, it's real complicated. So I thought the secret lied in the complexity, and I just had to find what nobody else found, except everybody has done the same thing. So maybe the thing to do is not do what they do and not find something secret, but find something that you can narrate that becomes simple. The tough part is actually taking the trades and doing work, knowing where your trade shows up and that you stay out of the market when you don't have an edge. The casinos don't play games without edges. They don't make them up as they go. They don't get emotional. So let's look at this. Now, remember how we were trading outside in and this was retail? Well, we rejected that area. Now we rotated in here. This is retail. Too high. Now we're down here. This is our outside edge. We're under yesterday's low. So we can come up in here, take stops, or let me look a little further. Right here was the last location. It was too high, right there. So this is an outside edge, and these are not trade recommendations. This is our targeting, don't forget. So I'm looking theoretically for this and maybe 44.20-ish. Too high. Go back a little further so you can see it. Remember, this is the short. This was support. You see where it is, LVN. This is the last chance to mean revert. It does the opposite. It breaks below. So now this is the outside edge here. Is everybody with me? Can you see why this was a key location? Is everybody tracking? 53. So if this is now rejected, it's like the shoppers say, you know what, I'm not buying this thing. Oh, it's on sale, you can keep it. And this is where it changes from the long side, or you could have been short. Remember, I'm trading both sides, but let's assume you're just playing the long side. Once this happens, it's shorts only. And that's this right here. You can see the line, you can see the behavior. And here's your micro high volume. Here's your seller. This is questionable here. That's the test. There's the seller. This is the mic. Now, this is how you get into the trade. And this is where you got to have discipline and patience. So right here, you would know you want to be short. Do you sell it here? Where do you sell it here? I need to sell it here. And I have to have the patience and discipline to wait. And it's very hard for us because we're wired, FOMO and all that jazz. But this is the story. So in a fractal, too high, that's LVN. We're under it. In the microstructure, micro high volume, retail, seller, test, short here, or come back and test, short here. So short, short, stop, helmet. That's the last trade. Now, where's the next one? Possibly out in here, if it shows. No, no. Where are we? Oh, yeah, here we are. Not a recommendation. Funny how that happens. Watch. This is your micro high volume structure. This is a potential short, not a recommendation. Just saying. Let's just see what it might do. This is not a trade calling room. It can easily come back here. So what we're attempting to do here is and this is hard. Where's the outside edge? Now, yesterday's low, the IB low, we have a couple trades. We have structured trades in the Trader Lab, by the way. This is called, so what you have right here is this is a potential short, and this is which is structural, and this would be called the IB continuation trade, which would be up here, back here. Okay, so we have two structured trades. This is catching the falling knife in midair trade, and this is the more structured trade in the Trader Lab, which is called the IB continuation trade. For me, there's no longs. You, up to you. Me, not so much. So I know if I come up in here, this is an area. Remember, horseshoes and hand grenades. So there's retail stops above here. I know that. Remember, think like a retail trader. Don't act like one. I know this is microstructure. I had my sellers. I know this can be an aggressive short, and it is aggressive. And I also know there's stops here. So this is an area. So let's observe it. And remember where our targets are. These are not trade recommendations. You know that. This is our target. And then 20. So, you know. And don't forget FOMC, so all bets are off. I don't trade FOMC, I trade after it. So let's observe. Are there any questions while we're waiting for this to ferment? And by the way, if you're in the Bookmap Discord Trader Lab chat, this stream will be available, and it's always available exclusively to the Trader Lab participants for at least 24 hours. So you can review the stream and see, kind of line it up with what you were thinking and doing and see if you can create conditional statements. The issue for all of us is trying to recognize the current and developing condition of the market and where it might change. That's something that is the bigger issue for all of us. It was long this morning, then it went rotational, then it broke apart and it turned short. How can you define the changes? That is the main obstacle. The structured trades, there's 60 PDFs you can download, and it's available to everyone in the Bookmap Trader Lab chat of these structured trades. So you can reverse engineer those. But if you can't align them, that's really the bigger problem. But you're zigging, the market zags. Now we all take stops, we all get run over. It's just part of the joy of taking risk and managing risk. But what happens? Where might it happen? And where's the probability of an outcome? So this is what we want to be watching. This is the area outside. Now remember, it can come up here because this was too high, or it could just come up in here, pick these stops off, and if we get exhaustion, this is called the IB continuation trade. So we're going to watch. This is a structured area. Now, by the way, what is a structured trade? They're locations, and then you look at microstructures for triggers, okay? Because it's all built on the same process. Where do retail traders keep their stops? In here. And there's the open also. So we want to just see the behavior here. And these are not trade recommendations. You shouldn't be doing any of this because every trade is random. So, the fact that this is a structured trade doesn't mean anything because we all take stops. So the thing to do is let's be looking now. We're in a location. So let's try to see the behavior. And I'll look at your questions while we're waiting for this thing. Stop divergence, potential triggering structure. Let's watch, okay? Well, yeah, Cocobolo, I see what you're saying. You know, the I think the learning doesn't come from like what I'm doing right now. I'm narrating live. Yeah, I understand. But if we can't go back and see process and understand interpretation, then I don't think we can put pieces together so that when we come to structures that might have an edge or might not, that we can activate. We need to know why we might want to get short and where. But the why is the most important thing. It's not that this might work or not work. It is not that. This is a potential short. We know that. This is our triggering structure. This is our location, and we don't know. I mean, like any trade we put on, it could do whatever it does, right? And if you're in the trader lab, you know what this is, right? I'm not speaking to you, I'm speaking to everyone. What is this if you're in the trader lab? What do we call this? IB continuation trade, correct. And it's available to all you guys in the Bookmap Discord Trader Lab, those 60 PDFs that I, offer to you guys. And you don't have to be a Bookmap subscriber. You'll never be solicited. You can take this and reverse engineer it. And it's work, of course, and you need to know where these pieces fit. This is the thing that most traders get wrong, I think, at least I'm only going to talk about me, what I got wrong because I was kind of like mechanical in the without any sense of understanding the condition of the market. It was just like, oh, I always do such and such at the mid, like coming down to the mid when we were falling out of the structure. I'm not buying the mid, but I can assure you many retail traders did. Because why? Stops are under the mid. Now, in this context, where do retail traders keep their stops? Here. What do I want to see? I want to see potential microstructure and exhaustion. I have potential exhaustion. Now, all I have in a trade is potential. I have nothing more than that. But here's what I have. Trade and structured trades are like, it's like real estate, location, location, location. This is a location. Here's the liquidity. Here's the potential exhaustion. Here's the microstructure. Here's the seller. This is my high volume. If I come above here, I would take a stop, and I'm perfectly okay with it. Now, emotionally, I'm going to be annoyed. How about you? But I have to be okay with it because I'm the house and I'm playing against the gamblers, and the gamblers win over time. If I have an edge in this setup, in this structure, over time, I extract the dollars from the gamblers. Not necessarily this time, but over a large sample size. What's my job now? To get risk neutral, to buy my stop so that if it comes back up here, I scratch. That's my first objective. What is my probability if I take this structured trade in this context of getting risk neutral before my stop gets taken out? That's the first question. Do you have a positive expectancy? If the answer is yes, it gives you the courage to put the trade on when it's in alignment, accepting that you will take full stops when you don't get scaled. That's the reality, and you need to get used to it. Too high, seller, too high, seller, microstructure here, check, seller, microstructure here, seller. Is everybody tracking? Your initial stop is here. The distance from your entry, subject to how you want to play. Let's say you got in here. This is your stop. Your distance to get risk neutral. You take and now I only talk about two contracts as a primer uh, process to understand risk management, risk neutralization, and emotional management. If you know you have a positive expectancy to enter with a structured trade, which we identified before the fact, right? Then, and this was another area, right? So this was the area, right? Retail trader behavior. Oh, let's put our stop here. Thank you. We want you there so we can fade you. Now you get risk neutral. What's your probability? Is it positive? You open to your trade plan. You're waiting for this trade. You're not making it up. You know where your trade is. You anticipate it. Now what's going to happen? Flip the coin. It's 50-50. If I get risk neutral, here's what happens. First of all, the worst that happens is if my stop is here and it comes back and takes me out, I scratch and my broker sends me a gift basket. Or I take a full stop, or I have a trade management process because I have this as my next target. You can be operating with a two lot. This is how you build out a trade plan. You need to understand the condition of the market. It changes continually. And remember, there's no way to know. Where's this thing going? I don't know. It might just come here. Might just test this liquidity. And here's the other thing you can anticipate. If we do come down here, you can anticipate profit taking, scaling ahead of the low. Why? It's normal. Don't you anticipate that? Get out ahead yesterday's high. Take a profit. Take a scale. Why? Profit taking. So we might underline, get back here, and this is the target. Now here's the other thing to remember. Right here is retail in this distribution. So this was outside, stop pick, continuation trade. This is retail. It was too low right here. This is too low right here. This is retail from the last time we were here, and it's the same. Let me take you back. It's the same as that. So it's like a bracketing structure. So this was too high, high of the day, who knows? Wouldn't you like to know? I'm waiting for that. Ask the magic 8 ball. This is too high from yesterday, and this is too low last time we were down here. So that's why if this is too high, we have the potential to come back and check, is this still too low? I suspect it is not too low, but I can't predict, so I target. And then if we take it out, I got this. Okay? Is everybody tracking? Does this make sense? And now in the fractals, this is retail. So if I can get under here, then I have this and this. Any questions? Hope it makes sense. Um, Hi, Joe. Well, the stops, I take them, for me, the stop, I should say, the icebergs are kind of incidental unless they're significant. So they're not, and again, it's personal. I think the way I look at this, and if you come to Trader Lab, by the way, there's a primer webinar that I did that I think addresses this in the sense of it's a priority of inputs. So if you think about a decision matrix, where does the behavior of an iceberg come into all of this? This is the chassis, because this is the basis of what creates the market. The icebergs don't create the market, they're in the market, right? What actually reflects the market is the volume and the price. Because if you get high volume and the market says, no, I'm not going to pay that, think of it like shopping. That's too high. When we pause and rotate and we create volume, if we leave it, it's mispriced. Now down here is retail. We left it when we came up here. So we can come back here. We can come back here. So how does the iceberg fit in all this? Well, for me, it's not a primary input. When I notice icebergs is when 3,000 go off, and I'm not, here's 700 down here, you know? Well, what am I supposed to do with that information? I don't do anything with it. Only if I see behavior. And then it's not, all it tells me is that's a level that's important to those participants. Does that make sense? So I hope that makes some sense, Joe. Um, I really try not see one of the things in a trade, call it a decision matrix or a process, and for me it's process driven, because if I start changing pieces around, I'm doing what most retail traders do, is I'm mixing and I'm flipping around a decision process or hierarchy of inputs. So this is my chassis that I build everything on, because it's telling me what the participants, which is really the basis of what the market's all about. It's not about indicators. It's not even about incidental behavior. There's so many different participants active in the market. Um, HFTs, hedge funds, market makers, calendar spreads, you name it, they're in here. Algos, right? Everybody. We don't know the time frame these guys are operating in, you know? I don't know. I mean, right here, is this guy selling and then covering here? What about this one? Is he getting long, or is he covering a short from someplace else? See, there's no way to know. So I have to put that kind of in the back burner because I don't know what it means. My truth comes from the participant behavior. Right here, too high, break, volume, break, too high, volume, break. Remember, and I'm anticipating potential bouncing around here. And where's my volume? Too low, too low. All it means is it can rotate off here, it'll do whatever. This is our short structured trade. So the icebergs are not part of this. They might be. Now, if we come down and I see 5,000 icebergs go off, then I have a different thought process. Okay. I don't get long. because the market can easily go under that iceberg buying because they're in a different business than us. They don't care, you know. And I can tell you, I've worked with guys that run hedge funds, quants. I understand there's different processes and participants. So I don't treat these pieces equally because I'm not in that business. I certainly notice it. And if you study iceberg behavior, and one of the streamers, Scott Pulcini, um, who's in the Discord, Bookmap Discord, has a channel where I think it's every Thursday. He specifically how he uses icebergs. And he actually has built process around icebergs. Now, whether or not that would work for you, everything, is different. Um, he trades large swings. So for him, big targets, big risk. And again, large risk, large targets is really relative to account size, trade management and all that. Neither here nor there. Uh, what I'm doing is really, I think, more structured for retail traders who want to learn how to the business of trading, and I try to take a global approach to it. You know, plan, context, understanding. If you're in the trader lab, you would understand why this is a short, and I think that is something that maybe is useful. You would also understand why this is a target. You would also understand why this, that was at the high of the day that I pointed out, was also a target. I don't think most retail traders have any idea what this is all about because they have gone down indicator world, which is what we all do because we get a software package and we think it's a matter of time frames and indicators alignment and that the indicator translates. And I always come back to why do we use indicators? Well, we're looking for translation. Well, if we don't understand market mechanics, we're going to let the indicators do the work. It's almost like a red light, green light process. And I'm going to suggest that for most retail traders, the outcome doing that is not so good. That's why the failure rate for retail traders is astronomical, to use a very soft term. So I found over time, and I'm only talking again about me, that I was approaching this like everybody else, and then it's logical. Why should I think that my outcome will be different? Am I going to find the needle in the haystack that everybody else has been looking for since technical analysis came out into the retail space? I started in 1980, and I can tell you, I've done a lot of looking under the hood for the quote secret sauce. You know, for me, I never found it. And I'm telling you, and I'm talking in depth and not just the regular stuff, but system design and the rest of it. I was a money manager, so I'm going to tell you, I've been there, done that, and you know, I've done a lot of things in trading, and the learning curve is horrendous because I certainly didn't understand market mechanics. I thought market mechanics was indicator based. You see. It's not the case. It's participant based. So we use indicators to try to translate. That's really what an indicator is. All I'm doing is using the participant behavior to translate. I don't have an indicator. I have volume and price because it reveals shopping. And if you remove all the mystery of trading, what is it? What's too high? What's too low? And if we can come out to a price at a location that is vetted and we get a structure in micro so I can enter and put my stop behind it, I now have a structure that I can manage my risk with. Then if I've vetted and I'm in alignment and I have a vetted trade plan, what's my probability of getting a scale so I can now be risk neutral before taking a full stop? Is it positive? Well, if it's a positive expectancy, it means over time, I'm going to probably scale more often than I take a stop. I'll take stops, of course. I do. Who doesn't? But if I have a better chance of getting risk neutral, remember I said we'd anticipate a reaction here? Why? Retail trader behavior. And you got this. But where's our target? Here and then, right? Is everybody tracking? Let me show you what these PDFs look like, guys. And I appreciate you visit the trading lab today. It's FOMC, so you got to wear a helmet. I don't trade FOMC. I trade after FOMC and whenever. Doesn't matter. But I also risk management is job number one. Um, so these are available. These are structured trades that I refer to here. And I'm not a vendor. There's no trading course. There's nothing to sell. It's all free. You don't have to be a Bookmap subscriber. You won't be solicited, so here's why, you know, and some of this, these were done haphazardly. These were done before I ever started. Bookmap asked me if I would stream. These go back to 2020. I mean, they're just things I tossed out here. October 2020. Illustration. Anyway, it'll give you some ideas about the auction, how it works. Here's the IBF setup. This is a counter trend trade, which is not appropriate in this configuration today, but you're all welcome to that. And there's a link in the bottom of YouTube that says visit the Discord chat. You don't have to be a Bookmap subscriber now, ever, never. You won't be solicited. You could download the 60 PDFs. And there's something else. There's a library of webinars in there that I've done over the past year, I guess. Some of them up to 4 hours long. And I do get requests for real-time narration. Those are real-time narration. And you just have to strap yourself in, have a pizza delivered and maybe a cocktail. It might be helpful. And you'll have those trend configurations and then transitions. When you go, like, for example, how do you trade a day like today? Well, it was long. And then it's outside in trading. That's what we were doing. That's called mean reversion. That's a context in a context. And most of us don't understand how to operate inside. And yesterday was the opposite, downtrend and then mean reversion outside from the top down. And our extended target was 50 on the downside. And that was at the end of yesterday's stream. We got to 47. Remember, there's no precision in any of this. And right now, what was the target? Ahead of the low. Why? Retail trader behavior. And then what? You're holding for 38 or you're done with the trade, subject to your trade management. This is as complicated as this is, as long as you accept that it's random. Hope you got something out of this. Come visit the Trader Lab. If you got something out of this in YouTube, and I hope you get something from the time we visit together, and I appreciate you coming by. Please give a thumb up and visit the Trader Lab. Download the 60 PDFs. It's a community of like-minded traders looking to leverage their collective experience. We've all done the same stuff. We all think we're unique, but I have to tell you, we're really the same. The difference is if you're waking up in Trader Groundhog Day doing derivatives of a process that doesn't work, so you try different things, which we all have, and it doesn't work, and you're experiencing Trader Groundhog Day, why would you keep doing it? I mean, it's just a question. I certainly spent years doing it, and I wish I could get that time back. But there was no computers, there was no streaming, there was no internet when I started trading. So it was a different time, a different world. No volume, no domes, nada. I think, and no computers. We had dumb terminals when I started. So I'm just saying, I had a horrendous learning curve, and it was very painful and it was expensive. But over time, I started eliminating what didn't work. After I figured out I was only replicating a process that was defective, and I didn't know that. So I kept doing this derivatives of a defective process. And most retail traders, I suspect, are doing the same thing. And that's why I call it Trader Groundhog Day. So let's remember, this was our short, risk neutral, stop here, potential trade management, up to you. You have to vet it, know what overtime gives you, next target, and if things get absolutely nasty, next target there. Not a recommendation. Follow a trade plan. If you don't have a plan, visit the Trader Lab. If you're not getting the results that you want, you might be able to pick up some ideas from Trader Lab. There's no right way to trade, but if you can't measure it, I'm going to suggest that's not the right way to trade either. Thanks again, guys. Have a great day. FOMC. So mind your risk. Be patient. There's always another bus coming by. Thanks again. Thumb up, please, on YouTube, and I'll see you guys tomorrow.